Welcome to the latest edition of PwC's International Tax News. I'm Doug McHoney, PwC's International Tax Services Global Leader. In this edition, we cover a few tax updates from around the world, including my favorite topic, Pillar 2. If you would like to go in-depth on similar topics, check out the Cross-Border Tax Talks podcast, in video on YouTube or in audio wherever you find your podcasts. Now let's turn to our current edition. First, on June 17th, the OECD Inclusive Framework released an additional round of Pillar 2 administrative guidance. It addresses the application of the recapture rule applicable to deferred tax liabilities, cross-border allocation of current and deferred taxes, allocation of profits and taxes in certain structures involving flow-through entities, and the treatment of securitization vehicles. This is the fourth set of administrative guidance released by the Inclusive Framework, following packages released in February, July, and December, all in 2023. Further guidance is expected across a large range of issues, but not likely until the end of this year. Next, countries worldwide are enacting procedures that require in-scope groups and entities to register before making Pillar 2 payments. In Belgium, for example, multinational companies and large domestic groups with a Belgian constituent entity need to file a notification at the Crossroads Bank for Enterprises, regardless of whether the ultimate parent entity is located in Belgium or another jurisdiction. Those taxpayers who already are subject to Pillar 2 in Belgium must register by July 13th of this year. Finally, Barbados has implemented significant reforms to its corporate tax regime through the enactment of the Income Tax Act and a new standalone Corporation Top-Up Tax Act. A top-up tax of 15% was introduced and is effective as of January 1st, 2024. There is, however, transitional relief available to MNE groups where the MNE group is deemed to be in an initial phase of international activity, or the income of an MNE group is not subject to an IIR or UTPR in another jurisdiction for the first fiscal year commencing on or after January 1st, 2024. Additionally, both a de minimis exclusion election and transitional safe harbor election are available. Thank you for reading PwC's International Tax News. I look forward to speaking with you again on the next edition or on the next episode of the Cross-Border Tax Talks podcast.